Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I am the chief strategist here at OptionsPlay. And today we're here to talk about a topic that is fairly near and dear to my heart, which is technical analysis and merging technical analysis with options trading. And this is important for us to talk about because a lot of investors spend quite a bit of time looking at charts. We use them to determine opportunities in the market, triggers to get in and out. And there's a lot of investments that people make in their charting, whether it's an indicator or a strategy, that they spend their time looking at charts. But the reality of trading is the fact that the charts is not what generates profits and losses. It's the trades that you make off of those chart signals that generate profits and losses. So today what I want to do is I want to evaluate each option strategy and the different types of technical analysis that you may come across and make sure that you're applying the right option strategy to the different forms of technical analysis and hopefully provide a bit of a framework as you think about technical signals. Are you applying the right option strategy? That's what I'm hoping everyone will be able to walk away from here today. Now, before I get started, what I'm going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So I'll start off by giving everyone just a rundown of why I think technical analysis is valuable for your trading, or at least why it's valuable for me, and you can see if it's something that you think is equally valuable for you. Then we'll talk about three different option strategies that you can deploy when you're trading technical analysis. I'm not going to get into the details of each individual strategy. This is just a high-level review. And then we're going to talk about three major methods of technical analysis. We'll talk about price analysis and patterns. We'll talk about chart overlays, and we'll talk about momentum indicators. In each one of these, I will discuss what you get out of each form of technical analysis and why within each one, certain strategies are best. And more importantly, I want to make sure that everyone understands the framework of which we're looking at these to make our decision. And then we'll open this up for Q&A here at the very end. But the primary thing that I want to help investors walk away from today's session is a clear understanding as to how can I maximize my technical analysis with options trading. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And I have spent the last 16 years teaching retail and institutional investors an understanding of the markets and technical analysis and options trading. And this is something that really merges all of those things into a single lesson. So I'm actually quite excited to talk about it. So the first thing we want to discuss is just what value does technical analysis provide for a strategist like myself? So when we refer to technical analysis, this is really looking at past history of the markets and trying to use that to potentially forecast the price as to what is likely going to happen in the future. And the key word here is likely to happen, because nothing is a for sure guaranteed form of analysis. Any form of analysis you're doing is you're just simply trying to weight the probabilities and understand what is most likely going to happen. It doesn't mean it's going to happen, but I think that one of the most valuable aspects of technical analysis for me is the fact that it gives me three very important things that are useful for options trading. First, it gives me a sense for direction, whether I think the stock or ETF is headed higher or lower. Second, it gives me a sense for magnitude, whether I think this stock is going to go higher by $5, $10, $15, how much higher it's going to go. And most importantly, that some other forms of analysis does not provide is timing, giving me a sense for if I think the stock is going to move a certain amount, perhaps how long that might potentially take in order for it to move that far. So before I jump any further, how many of you currently use technical analysis in your trading? Please bring up your chat window at the bottom of your screen, and please type yes into the chat window if you use technical analysis or charting, and please type no if you do not use any form of technical analysis or charting in your analysis. Okay, I see mostly yeses, but I also at the same time see quite a few no's. So for those of you that answered no, hopefully this session gives you some idea as to why you might want to take a look at technical analysis, especially if you're trading options. And if you're not trading, if you're not using technical analysis, you might be missing out on some information that's extremely valuable as an options trader. So let's just first understand a little bit about technical analysis and what it provides and what limitations there are. First and foremost, technical analysis is the study of price. And what price provides you is a very objective view on the trends, because we all have feelings of trends. We all have a sense for a trend, but price makes the trend on the chart real. There's no substitute for price. You can't fool price. Price is the ultimate king of price, of trends. And that's why it's so important to study price. Price gives us an understanding as to what has happened, how the market is reacting to certain prices. It gives us a very objective view to the current trends of an underlying stock or asset or anything that has a price. But the most important aspect for me for technical analysis is the ability to apply a single source of analysis or a single method of analysis across all instruments with a price. So as a stock investor, you might be most importantly concerned about what's happening with the stock. But I would argue that as an investor these days, you can't just look at a stock in itself in isolation and that's it. You have to look at other things like the sector. You have to look at things like the market. You might have to look at interest rates or perhaps commodities or other things that are tied to what that stock deals in. However, if you're a fundamental analysis or if you're a statistical analyst, you're going to find that those forms of analysis may only be limited to the asset that you're trading, and you can't apply fundamental analysis to interest rates. You can't provide fundamental analysis to commodities. So these are all things that are interrelated to what you're trading. And in order to maximize your opportunity to potentially trade in that particular asset, knowing what's going on in its sector, in the commodities that perhaps influence the stock's price, it's important, right? So if you're looking at airlines, looking at what fuel prices look like, that's going to have an impact, but you can't apply fundamental analysis to fuel prices. So that's why it's important to use technical analysis, in my opinion, because the analysis techniques that I use for Delta Airlines is the exact same techniques that I would use to look at interest rates or fuel prices. And the second most important thing is the fact that the form of analysis that you're looking at is applicable on all time frames. So every single one of you watching this session today likely trades on a different time frame. Some of you are more active and you might trade on a 1 hour chart or a 30-minute chart or maybe even a 5-minute chart. But the analysis that you do on that time frame is the same as someone else who's a longer term investor looking at a daily or weekly or perhaps even monthly chart. The chart frequency doesn't changes, but the form of analysis does not. As a fundamental analysis, you cannot apply your fundamental analysis to intraday trading. It just doesn't work. That's why when you're trading these types of asset classes, knowing technical analysis allows you to be flexible, allows you to trade a lot of different instruments, allows you to have a view across a lot of instruments across all these different time frames. But there is one limitation of technical analysis that I tend to find that investors have a hard time grasping. And this is why it's so important for me to spend the time here today to discuss these things. One, it's important to understand that strategies typically only work in a certain environment, meaning some strategies work really well in a trending environment. Other strategies work really well when the stock is trading in a sideways motion. It's important to understand when your strategy works, because if a strategy doesn't work, you should look back at what's happened over the past few months and ask yourself, is this the right environment for my strategy to work? So if you trade a sideways strategy, if you will, and you look back over the past couple of months and you see the market has been a very strong trend, and you know that you've lost money on that past couple of months, you can ask yourself and say, okay, this wasn't the right condition for my strategy. There's nothing wrong with my strategy. It's just that the market conditions were not right. This allows you to audit your strategy and decide whether it's something that you need to improve on, or you just have to wait for the right market conditions. That's an important aspect of technical analysis. No strategy works all the time. And second thing, there's no such thing as a best strategy. I get this question a lot. What's the best moving average to use? What's the best indicator to use? What's the best stop loss to use? The reality is there's no such thing as a best. If there was a best, everyone would trade using only that, and no one would ever trade anything else. I promise you. Each form of technical analysis has its pros and cons. Each one has their drawbacks and limitations and benefits. You have to learn to understand those things before you can utilize technical analysis in your trading. So today, what we're going to do is we're going to go through 3 different option strategies across a wide range of different options, a wide range of technical analysis techniques to help you understand when you should use certain option strategies and when you should use others. But the first and foremost is that we're going to come across 2 general types of technical analysis. Both of them will give us a clear sense for direction, but some forms of technical analysis, you don't have a clear sense for magnitude. Other ones, you do have a clear sense for magnitude. And this is going to help bifurcate what type of strategy is suitable for that type of market environment. So let's first talk about strategies where you have a clear sense for direction, but you don't really have a clear sense for magnitude. This falls into two categories. Either you think the stock is going to make a quick and fast move, or you think it's going to be more of a slow or neutral move. Typically, quick and fast means there's a catalyst, meaning that there's an earnings coming up. There's some kind of event that you think could drive the stock to move fairly quickly, or maybe you see a lot of volume on a particular move and you think this thing can move fairly quickly. Then you just want to buy a call or a put. That's the easiest way to take a directional view when you're not exactly sure how far the stock can move. If you think the stock's going to make a more small or neutral move, that's when you want to sell credit spreads. We're going to go through quite a few different examples where credit spreads is going to be by far the best strategy to use depending on your chart analysis. And then on the flip side, you're going to have other forms of technical analysis where you have a clear sense for direction and a clear sense for magnitude. And for those strategies, you want to look at buying debit spreads, because debit spreads is one of the most efficient ways to take a directional view in the markets. When I say efficient, I mean risking the smallest amount of capital to make the largest potential return. Now, but it only typically works when you have a clear sense for a target price. If you don't have a clear sense for target price, debit spreads may not be the best strategy. So those are the 3 strategies we're going to discuss here during today's session. So what we're going to start off with is the most basic form of price analysis. It's just looking at the chart and looking at the price. No indicators, no nothing included on it, just looking at the price. And what we're looking for is prices at which the stock or asset reacts to. And the first thing you typically learn are what we call support and resistance levels. General area of support, meaning general areas where the stock tends to fall and reverse higher or reach and reverse lower. This is what we call horizontal support and resistance lines. And this is the first thing you want to learn when you're starting out in technical analysis and charting, because this is going to be the most powerful tool in your toolbox when it comes to charting, is looking at and reading price action. A lot of investors spend a lot of time looking at indicators and signal, things like that. I always tell investors, price is your first and foremost and most important indicator. And when we think about these, well, the next time it reaches a resistance level, we can think of it as we believe it's going to reach to the floor. When it reaches the floor, we believe it's going to reach the ceiling again. And when it reaches the ceiling, we think it's going to reach the floor again, right? That's the thesis behind support and resistance levels. Well, there's a few different ways that you can use support and resistance levels, because you can either use them as a reversal pattern, right? Which means that as we approach a support level, you're basically saying that I don't think it's going to go much lower from here, but that doesn't mean that you think it's going to reach all the way back up here, right? Just because it's reached the support level means that you could believe it's just going to move sideways, right? It doesn't necessarily have to go all the way up here. So for those where you have a clear sense for direction and a clear sense for magnitude, where you think the stock is going to reach the floor, back to the ceiling, then this is where you want to use a debit spread, because you have a clear sense for where it's going and how far you think it's going to go. But like I said, not every time you have that view. Sometimes times, just fundamentally speaking, maybe you don't particularly think the stock is that great. You don't think it's going to move all the way back up to 55, 56. You just simply think that, okay, we're near a support level. It's not going to go much lower, but I certainly think that it might just trade sideways for a while. If that's the case, you're best off selling a credit spread. This is where you have a clear sense for direction, but not a clear sense for magnitude. So it really depends on your views on the underlying stock beyond technical analysis. And this is really where, at least for myself, I merge technical with fundamental analysis. I look at the company. I look at my understanding of the company and the market that it operates in. Do I believe in the company? Do I believe in the sector that it's operating in? Do I think it's a good operator in that particular space? Those are the things that I start to look at in addition to technical analysis, because technical analysis gives me a sense for timing, it gives me a sense for direction, but it doesn't give me a strong sense for magnitude sometimes, and that's where fundamentals comes into play. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so now let's talk a little bit about the same support and resistance levels in a different way. So this is the same chart here, right? This was the chart before 50, 55, 56 has been this, we usually call this like a resistance zone, if you will. And what we see here is that this resistance zone, this resistance zone is getting broken out, right? You see the breakout here, a retest, and it's now starting to accelerate here to the upside. So here's an example of a stock that was recently trading within a range, and then after a while starts to break out above that range, right? This is a fantastic understanding of price analysis. Stock is resting, the stock is trading within a range, and when it breaks out from its range, it's likely to going to continue higher. Well, this is really where when the stock breaks out to new highs, many times when a stock breaks out to new highs, you don't really have any price history, right? It's at an all-time high. It's never been here before. So how do you know how far the stock can go? This is really where it depends on why did it break out higher? Did it break out higher because of earnings? Was there a catalyst that moved it? Or was it just maybe, the markets are moving higher and the stock is moving higher? You have to ask yourself what the catalyst is, because if you think there's a strong catalyst that this will be a quick and fast move, right? Maybe there's a lot of volume behind it. There's earnings that just came out. Then maybe buying a call option is best, because that's going to allow you to take advantage of that move in a quick and fast fashion. But any other move that's kind of more slower, that's just breaking out of a range and you think it's going to continue moving higher, you're better off selling a credit spread, because a credit spread is basically saying once it breaks out of this range, it's unlikely to fall back into this range. And a credit spread will make money as long as the stock stays above this particular range. It doesn't have to move substantially above the range. As long as it stays here or higher, you'll be able to make profits. And that's really where a credit spread comes into play. And you really want to think about this in your strategies. You don't want to just buy calls every time a stock breaks out, because just because the breakout doesn't mean there's going to be a follow through. Many times breakouts can simply come back and retest it and start a new range, right? And if it's just starting another range, you want to make sure that you're profitable as long as it holds that range. And that's where selling a credit spread comes into play. But sometimes when stock starts to break down below a support level, many times breakdowns will have prior levels to look at, right? The stock rallies and then breaks down from its trading range. So usually breakdowns, you have a little bit more price history to look at. So usually when you have a breakdown, you can look at potential targets to the downside, previous support levels, previous floors, if you will. Those can be your target prices. So for those, we tend to find that debit spreads many times are useful. Long puts can be used as well, especially if there's a catalyst event. Let's say earnings comes out and a stock really starts to drop below support and you're expecting it to be a quick and fast move, then you're better off buying an outright put rather than buying a put spread. But this is an example of, some of the strategies that we trade here at OptionsPlay. Does that make sense? Please type 2 into the chat window if that makes sense to you. Okay, perfect. Now, let's talk a little bit about chart patterns. And chart patterns, there are hundreds of them. So I'm not going to be able to cover most. I'm not going to be able to scratch the surface here, but I will cover some of the more popular ones that most investors may be familiar with if you're trading using the charts. And When you look at a chart pattern, the most important thing you want to ask yourself is, does the chart pattern give me a clear sense for direction, which pretty much every chart pattern does? And more importantly, does it give me a sense for magnitude? And what you're going to find is that some chart patterns really just give you a clear sense for direction, but there's no indication of how far the stock can move in that particular direction. And then there are other forms of chart patterns that have a very clear target price or a very clear sense for magnitude. And depending on which one of these two the chart pattern you're trading falls under, that's going to help you determine the right strategy. So if we talk about double tops and double tops look like this. Double bottoms look like that. I mean, basically one is an M and one is a W, right? A double bottom basically tells you that the stock is going to rise. A double top tells you that a stock is going to decline. But just the double top and the double bottom itself doesn't tell you anything about how far the stock can move. It only tells you the stock is going to reverse directions. It doesn't tell you how far it's going to reverse directions. That's why when you come across a double top or a double bottom, the best thing to do is to sell a credit spread. Now, another form of topping formation that's similar to the double top is what we call a head and shoulders. A head and shoulders pattern is really where you have a left shoulder, a right shoulder, and what we call a head. And this is a reversal pattern that targets a move to the downside. Now, when we look at head and shoulders patterns, this gives you a clear sense for direction, but it also gives you a clear sense for magnitude because the size of the head to the neckline can be projected down as a target price. So you have a clear sense for how far the stock can move once it completes a head and shoulders pattern. So this gives you clear sense for direction, clear sense for magnitude. So the only decision that you have to make is whether you use puts or a put debit spread. And that all comes down to whether there's a catalyst event coming up, like an earnings event. If there is, you might want to just buy that put and see that acceleration. If you think it's going to be more muted, then buying that debit spread may be more suitable. And there are other reversal patterns like a cup and handle, which is a different type of reversal patterns where you have a large base, a small handle. So basically you have a stock that's kind of completed a long-term bottoming formation, tries to break out but fails, and then comes back and finally breaks out again. This is really also a strategy with a clear sense of direction and a clear sense for magnitude because you can measure the size of the cup to the breakout level, and this gives you a target price that you think the stock is going to reach here to the upside. So long calls or debit spreads are suitable. And lastly, flags and pendants. This is something that we talk about here a lot at OptionsPlay. When a stock has a big move to the upside and then it rests for a period of time, think about Amazon and what Amazon has been doing for the last 9 months after the pandemic. And then when it starts to finally break out above this level here, what we usually use is the initial move to project the further move here to the upside. So when you have a flag or a pendant, and there's many different formations of this, some of them look like this. So you have what we call like a flag, and then it finally breaks out. Other ones look like this, where it kind of trades in more of a rectangle, and this is what we call like something like that, and then it finally breaks out. But this is what we call continuation patterns, right? So double tops, head and shoulders, cup and handle, those are reversal patterns. That means the stock has reached a certain price and then it's now going to reverse. A continuation pattern is just a stock is moving in a particular direction, it has a period of rest, and then it continues in the same direction. And these will usually have also a clear sense for direction and a clear sense for magnitude. So buying a debit spread typically is the best way to trade these. And, inverse head and shoulders the exact same way. You have the clear sense of direction and a clear sense for magnitude. So both of these are ones that you can use. But the important question to ask is, do I have a clear sense for direction and magnitude? If I do, you want to choose the right strategy. Does that make sense? Please type 3 into the chat window if that makes sense to you. Perfect. Now, let's get into some of the indicators. Very, very popular amongst traders. So things such as moving averages is probably one of the most, I would say, most popular technical indicator. And many investors trade using moving averages. And a lot of times I see users who will, buy a stock when it crosses above the 200-day moving average, or they'll buy a call option when the stock crosses above the 200-day moving average. But the one thing that I think a lot of investors do not really consider when they're generating a signal or making a trade off of a moving average crossover is that the moving average, when the stock crosses above or below its moving average, that crossover in itself tells you nothing about how far that stock is going to move, right? Just because the stock crosses below the 200-day moving average gives you no indication as to whether that stock is going to move a few dollars lower, $10 lower, or maybe $30 lower. The crossover itself contains no information about how far the stock can go. Same thing for crossovers. When the stock crosses over, you have no idea if it's going to cross over. You have no idea if it's going to cross over for a few days and then cross back below, or it's going to stay above that moving average for quite some time. And that's really the challenge here with moving average crossovers, which is why, in my opinion, one of the best strategies to use is a credit spread. Because when a stock crosses below its moving average, the only information that I'm really getting from that is that it's unlikely to get back above that moving average. And what strategy allows you to profit from that? It's selling credit spreads. So if the stock crosses below a moving average, I can sell a call credit spread. Let's say I sell a 1 month call credit spread. Then I can sell another 1 month credit spread and sell another 1 month credit spread. And I keep doing this over and over again until the stock crosses back above its moving average. Once I do that, now I can start selling put credit spreads. I'll sell a 1 month put credit spread here, sell another 1 month put credit spread there, sell another 1 month put credit spread there. And I just keep doing this over and over again until the stock crosses back below the moving average. So, and you can keep doing this over and over again, because again, when the moving average crossover happens, you have no idea how long it's going to stay for. It could be there for a week, it could be there for years. The crossover itself contains no information about that, which is why if you're going to use moving averages in your primary trading process, then selling credit spreads is going to be the better strategy to use. Does that make sense? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so there is one variation of moving averages that you can use, which is Bollinger Bands, that do provide not only a clear sense of direction, but also a clear sense for magnitude. And for Bollinger Bands, it's used in a different method. It's used as a mean reversion strategy. So a Bollinger Band is basically the 2 standard deviations of the 20-period moving average. And what that means is that if the stock exceeds the upper Bollinger Band, it is outside of 2 standard deviations of price. So every time it exceeds these upper bands or lower bands, it means that there's a high chance of a mean reversion back to the trend. And the trend is the moving average. So as you can see here, you can either have a long or a short back to that moving average. So when you're trading Bollinger Bands, this is when you have a clear sense for direction and you have a clear sense for magnitude. So using a debit spread is a suitable strategy because you're expecting the stock to make a move in a particular direction and you have a clear sense for how far that stock can move. And debit spreads are a fairly efficient way in order to play that. Does that make sense? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, last one, leading indicators. Many of us use indicators such as this, but it's MACD, RSI, stochastics. A lot of investors use these to generate signals. When you get a crossover, when you get a crossover like this, that's a buy signal. And you've got a crossover like that, that's a sell signal. And you can use them over and over again and generate all these buys and sell signals on a particular chart. However, it's important that investors think about this type of buy or sell signal, because you have to ask yourself, when an indicator crosses over, does it tell you anything about how far the stock can move? And the answer is no, right? At the time that this signal is generated, the sell signal is generated, nothing about this sell signal is any different than this sell signal, but this one moved this much and this one moved that much. The two are virtually identical from a signals perspective, which is why when you're using these types of strategies, or when you're using these types of overbought or oversold signals, they are not good for buying calls or buying puts, generally speaking, because it's not frequent that you get a big move like that. It's far more frequent that you get small moves like this, right? They're not big movers. They're not gonna materialize into big gains or big moves on the other side. And you can see so many of them. There's a lot of false signals here as well, right? Where it moves for a couple of days and starts to move, which is why when you're going to use these signals as an entry signal, the best strategy to use is a credit spread, because once you have the sell signal, that tells you that this is the price that the stock is unlikely to get back above, meaning it's more likely to be down here than to be back up there. And the best strategy for that is a credit spread. Every time you get a sell signal, you can sell a credit spread. And that means that it's, as long as it stays below that price, you're going to be profitable. Same thing here. If you sell a credit spread here because the stock is now generating a buy signal, that's how you can generate this over and over again. Every single time it generates a buy signal, you can look at selling a credit spread. So that's really how you want to think about using these types of leading indicators for your trading, not as any other strategy, but for credit spreads. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Okay, so just a review of everything that we discussed here today. Now, if you are a long-term technical analysis user or first-time technical analysis user, I cannot express enough how important looking at price is. I see a lot of investors kind of glance over price because they're so entrenched in their indicators. They're looking at moving averages. They're looking at RSI, stochastics, MACD, all these indicators, thinking that the secret is in the indicators. But all of those indicators are really derived from price, which is why you should first look at price. It's the most important indicator. Looking at support and resistance levels, understanding where the stock is currently trading, if it's breaking out above from a trend, breaking below a trend, that's far more important than anything else. And it's the only indicator that's going to help you determine both direction and magnitude. No technical indicator will really give you a sense for magnitude. Indicators should only be used to provide confirmation. So for example, if you have a stock that's breaking out from a trading range, right? It's trading in a range, starting to break out here. Look at only after the price breaks out above the range do you look at indicators to see if it's confirmed that breakout. You should only use indicators as a confirmation, never as a signal in itself. And I always encourage investors, try to see if you can use fewer indicators in your charting. And, if you're going to use a momentum indicator, use one momentum indicator. If you're going to use a trend indicator, use one trend indicator. Don't use lots of them, right? If you're the type of trader who's got 7 moving averages on your charts, I promise you, the only thing you're going to get out of that is analysis paralysis, because at some point, all 7 moving averages are never going to move in the same direction. You're always going to have one that's moving in one direction, other ones moving in other ones, and you get these conflicting signals. And that's really where we tend to find a lot of investors struggle with technical analysis. Fewer indicators will generate better results. And the most important thing is that even the best technical strategies, and you can download our technical analysis report that's available on our website, you see that even the best strategies will generate at least 7 to 8 consecutive false signals in its lifetime. So what that means is that even the best technical strategies are not going to be able to avoid having some point a series of false signals. And as a trader, your goal is not to design a trading system or to find strategies that don't have consecutive losses, because it's just not going to happen. The reality of technical analysis trading is that you're going to have a series of consecutive signals. And this goes into some of the things we've discussed recently about consecutive losing trades. But so your goal is not to find strategies that avoid consecutive losses. Your goal as a trader is to make sure that you can survive those consecutive losses. That's how you survive as a trader in the long run. And the only way you can do that is if you stay consistent with the same strategy. I unfortunately see too many investors who don't really have a strong fundamental grasp of their strategy. So as soon as they see 5, 6, 7 consecutive losses in a row, they lose confidence in what they're doing. And instead of instead of thinking about risk management, which is really what you should be focused on, they basically jump ship. They basically say, this strategy sucks, I'm going to go find a new one. They throw away whatever indicator they purchased or whatever indicator they just spent a lot of time researching and learning, and they try to find some new indicator, thinking that the new indicator will be somehow the solution to their problems. But if you don't fix your risk management problems, the new indicator, at some point, somewhere down the line, you're going to have the same problem where you're going to come across 7 or 8 consecutive losses in a row again. May not happen tomorrow, may not happen next week, but at some point it's going to happen. And if you don't learn to survive those, it's just going to be a cycle that continues to repeat itself over and over and over again. And as a market strategist over the last 16 years, that's the pattern that I've noticed. Successful traders are the ones that look at those consecutive losses and say to themselves, what can I do to prevent this from blowing up my accounts? The ones that are able to adjust their risk management to prevent that from blowing up their accounts are the ones that stay consistent with the strategy and are able to trade it over the long run. And the ones that don't use the risk management process will typically blow up their accounts or blow up a good portion of their accounts, give up on the strategy, and then they'll try to find a new strategy, hoping that somehow the new strategy will prevent this, only to find that cycle to repeat over and over again. If anyone can relate to that, please type 7 into the chat window. If you've kind of went from one service or one type of strategy, maybe had some large losses, said, screw this strategy, I'm going to find a new strategy, only to find a few months later or a few years later, the exact same thing happens again. And maybe you've done that more than twice or 3 times, right? Again, this is what I see a lot from investors. The problem is not your strategy. The problem is the fact that your risk management is not strong enough to survive those 7 to 8 consecutive losing false signals, because every option strategy, every strategy at some point has these string of losers. And hopefully in my session from a couple of weeks ago, you saw just how frequently they happen. They happen actually quite often, and you really have to anticipate it. If you don't anticipate it, if you don't adjust your risk management, I unfortunately cannot express enough how this is just a cycle that's just going to keep repeating itself over and over and over again. So hopefully today gives you some information in conjunction to what we learned a couple of weeks ago as to why you need to adjust your risk management. So lastly, when it comes to option strategies, make sure you ask yourself, the signal that I'm getting from technical analysis, do I have a clear sense for direction, and do I have a clear sense for magnitude? Depending on the answer to those 2 questions, you want to select the optimal option strategy off the back of it. And I always encourage investors to experiment with OptionsPlay. You have paper trading capabilities on your OptionsPlay tool that allows you to test debit spreads, credit spreads, calls and puts next to each other. If you're new to this, you're trying it out, paper trade these different strategies, paper trade all of them, right? Let's say you're bearish on Apple, buy a put, buy a debit spread, sell a credit spread, do them at the same time. Come back a couple of weeks later, see how they're performing, see which ones perform better, see if your outlook on Apple played out. And if it did, which one gave you the best results? If it didn't work out, which one had the least amount of losses? That's how you learn as a trader. And hopefully we can provide you with the tools to do so. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of the framework that you need to think about when you're using technical analysis with options trading. So with that, what I'll do is I'll open this up for Q&A. There is a Q&A section at the bottom of your screen. If you could please type your questions in the Q&A section, I'll try to answer as many questions as I have time for here today. Great question here. How do you determine magnitude? Well, magnitude is usually based on the chart, right? Usually you look at some form of prior support and resistance to determine, magnitude. Price is always going to be your most powerful tool, and price will almost always be the way to determine magnitude. What are some leading and lagging indicator examples? Technically, all indicators are lagging because it takes historical price to calculate, but we usually think of moving averages, what we call lagging indicators, and then we use any of the momentum oscillators like MACD, stochastics, RSI. Those are typically falls under what they call the leading indicator category. Is parabolic SAR and DMI a leading or lagging indicator? Technically, I think that both falls under the leading category section, but remember, all indicators is using historical price to calculate. So by using historical price, by definition, it's a lagging indicator. I haven't had much success with credit spreads. Seems that you really don't get to keep all the premium that you initially receive, but losses can be steep. So Mark, I guess that depends on what type of credit spreads that you're selling. You know, we advocate for selling credit spreads where you're risking no more than $1.50 for every dollar that you can potentially make. That's going to prevent those steep losses. You know, I would encourage you to look at some of my videos on YouTube on you know, trading credit spreads and the different tools that we have here at OptionsPlay to help you find more optimal credit spreads. And we're actually launching a new version of the credit spread report to make it easier for you to sort and select. It just makes it a little easier for you to access these reports. But our credit spread opportunity report actually gives you credit spreads that provide as much income as possible. So the ones at the top of the list, if you can collect 40% of the width, that's going to give you a better risk to reward ratio than if you collect 30% of the width or 20% of the width. So I hope that you take a look at that. What happened to your bike that was against the wall behind you? It's actually in the other room. It's still here. How often are you correct at predicting the magnitude of the move? So Douglas, this is probably, calculating magnitude is probably one of the most manual things to do. So it's really hard to algorithmically calculate the number of times you're able to predict the magnitude of the move. But I would say, just empirically speaking, I would say that you probably have somewhere between a 60 to 65% chance of calculating the magnitude of the move correctly, based on just the sheer amount of backtesting that I have done on the technical analysis side of things. The 60 to 65% range is typically what you will generally see for a good technical strategy. Is it right to say the more indicators giving you a signal and direction is a confirmation to say 4 indicators? No, not at all, Ken, because when you have 4 momentum indicators, those 4 momentum indicators are calculating the same thing. They're just slightly different mathematical calculations. So when you use RSI and MACD and all those, you expect them to largely be in line with each other. So having 4 indicators is not any stronger necessarily of a signal. Now, if you have signals on multiple time frames, that's a different story. If, let's say, you have a buy signal on a weekly chart and you have a buy signal on a daily chart, that does increase, in my opinion, the validity of the signal. But just having multiple indicators on the same time frame does not add anything to it. So it all comes back to risk management. Well, Ken, all roads lead back to risk management. I'll be, you know, at the end of the day, because it doesn't matter what trades you use. It doesn't matter what strategy you use. If you have poor risk management, you will at some point blow up your portfolio. But if you have good risk management, regardless of what how good or how bad your strategy is, you're less likely to blow up your portfolio. Will you use short dated spreads for a sudden price movement? Yes. You know, especially in this, you know, the market environments that we have now recently seen, where moves like this happen over such short periods of time and quickly correct, as we're seeing here right now, short periods that may just very quickly correct. You know, shorter dated, you know, calls and puts may make sense in this type of market environment if you're a short-term trader. So absolutely you can. Where do I find the paper trading tool in OptionsPlay? So if, let's say, you're looking to paper trade, right? I actually have a whole video here on YouTube. So I suggest you to take a look at my YouTube channel and type in paper trading OptionsPlay. But basically, on any strategy that you want to paper trade, you just simply click on the blue share button on that strategy. And when you click on the blue share button, you'll see this button here on the right-hand side. That will allow you to save this trade into your profile. And when you do that, what you can do is you can go into, once you created it, it'll be saved. You can go into your profile and go into shared trades. And this is going to be a collection of all the trades that you have placed. So let's say if you look at this Bed Bath & Beyond trade that I placed here on July 20th, where I've sold the 429 vertical spread on Bed Bath & Beyond, you can take a look at it and see how it's performed since then, right? So Bed Bath & Beyond has been down since then. So this is a trade that's down $82. So you can paper trade these strategies by clicking on the blue share button and then clicking on this, on this share link here on the right-hand side. On OptionsPlay, if the trades say buy 1 October call vertical, does it mean debit spread? William, the best thing to always do, no matter what you see on the platform, always click on the trade button. When you click on the trade button, it'll tell you exactly which leg to buy and which leg to sell. But yes, if we're telling you to buy a vertical spread, that's a debit spread. If we're telling you to sell a vertical spread, that is a credit spread. Can you eventually do a video on how to play volatility? So Wallace, I have recorded a video on straddles and strangles, which is, in my opinion, the only way for a retail trader to trade volatility. You can trade calendars and diagonals, but you're kind of hedged, if you will. The pure volatility plays are going to be straddles and strangles, but there are also quite a few risks with that. So just as long as you're careful and understand your risks, I would look at the video that I've hosted on straddles and strangles. Abraham, all of our videos that we post on YouTube have the links to the slides in the description. So whenever we send you the recording, you'll be able to download the slides in the description of the YouTube video. What's the best strategy? What's the best way to determine the strike price for different strategies? So we also have laid out those optimal strike prices for credit spreads in our video. You can find that on YouTube. I've recorded tons and tons of credit spread videos, but the general rule of thumb is to sell the 50 delta and buy back the 25 delta. So we'll show you exactly which strike to sell, which strike to buy to collect the amount of premium on that trade. How great is the use of parabolic SAR? So I'll be honest, I haven't done any back testing on parabolic SAR, and parabolic SAR is not so much an entry tool. It's more of an exit and trailing stop type tool. But I'll be honest, I have never tested the performance of parabolic SAR. I'm not a big fan of stochastics. I'm a big fan of RSI. That's predominantly what I use in my trading. Ichimoku Cloud is an interesting one. I know a lot of investors who do. Look, again, I go back to this point that there's no such thing as best indicator. Every indicator has its pros and cons. From my perspective, it doesn't matter which one you use, but select one, understand it, and stick with it. Don't use Ichimoku today, RSI tomorrow, the 50-day today, the 200-day tomorrow. That's when you're going to get inconsistent results. Find something that suits you from an understanding perspective. Find one that you kind of get and stick with it. But then also at the same time, apply the right risk management for each strategy. I will say different technical indicators will have drastically different number of false consecutive signals. For those of you that download our technical analysis backtesting report, which I also have a video on YouTube. I highly suggest you to look that up. Some indicators have as many as 22 false signals in a row when we backtested it over the last 13 years or so. And this is just over 13 years, meaning there was one indicator that generated 22 false signals in a row. The best performing indicator was CCI. I think that only generated a total of the maximum number of consecutive false signals, I think was 9. So different indicators do have very different number of false signals. And that is a big criteria in determining what is the right risk management technique for it. Because the more consecutive false signals an indicator can generate, the less you can risk per trade. The fewer the consecutive false signals it generates, the more you can risk per trade. So that's some of the things that you need to consider. Tony, thanks for another excellent presentation. How strictly should I keep to example collecting 1/3 of the width of a credit. Alexander, those are rules, in my opinion, that you should never break. In terms of the debit spread, I'm not a fan of the 1/4 width of the debit spread. I know Mike Coe on Options Action is a big fan of that. For me, I tend to find that debit spreads is highly dependent on whether there's a catalyst or not. If there's a catalyst, I think Mike's 4-to-1 risk reward, 3-to-1 risk reward ratio makes a lot of sense. But sometimes you don't have a catalyst coming up. So that's why, for example, if you look at my American Express trade from last week, I used an in-the-money debit spread that only had a little less than 2-to-1 risk to reward ratio because there's no catalyst coming up. So when you're trading a debit spread without a catalyst, that's when I tend to use, a smaller risk to reward ratio on a debit spread. So, but on a credit spread, I will never trade a credit spread that collects less than 1/3 of the width. Abraham, thank you so much. What is your favorite trend and momentum indicator? So, I use moving averages. And, the thing about moving averages is just how subjective it is, which is why we created the 1-month and 6-month trend indicator. This uses 3 different moving averages, the 20, the 50, and the 200-day, the 3 most popular moving averages. And we do the interpretation for you so that we take the subjectivity out of the equation. I can't help but think and see so many investors who use moving averages. Sometimes we'll use the slope of the moving average. Sometimes we'll use the 20-period moving average. Sometimes we use the 200-day moving average. And they always have different ways of using the moving average. You just kind of use it to confirm your own biases. And when you do that, that's when you get very inconsistent results. And one of the ways that we tackle that is by removing the indicators themselves and just giving you the interpretations. And these interpretations have not changed. We apply the same interpretations to every single stock the exact same way. This way you get a sense for what the trend of the stock is, how long it's been in that trend for, and you see it on your screen. So as you can see, the S&P 500 has been in a bullish trend for a very long time up until today when it started to turn slightly neutral. But as you can see, it pretty much has been bullish since March. That is the trend indicator that I use for my trading. Have you attempted to use a weekly indicator to address the trend and then only trade on the daily indicator signal? Yes, that is actually some of the screening criteria that we use for some of our signals. What type of trades do you recommend when stocks are at their highs/lows? So Michael, I again, go back to the framework of, do the highs and lows give you a sense for magnitude or direction? Use that as your framework to determine what is the best type of trades to do. Is there an ideal moving average? I promise you, if there was an ideal moving average, everyone would only use that moving average and never use any other moving average. There's no such thing as an ideal moving average. The shorter the moving average, the more frequent and but the more false signals. The longer the moving average, the less frequent the signals. So there's just pros and cons to each one. One is never better than the other. Do you ever look at time as a factor to evaluate rather than price? I'm not sure what you mean by that. I mean, ultimately, price is what you're trading. Time is not what you're trading. So time is an element, but price is what you're trading. How far do you go back into price history? Usually, I don't have to go more than a year, year and a half. That's usually as far as back as you need to go. Tony, you hardly mentioned naked call and put strategies. Don't you think low volatility environments, they are worth considering? So the reason that we don't look at naked call and put strategies is really because of the risk. We do sell quite a few puts. We talk a lot about selling puts on stocks that you want to acquire, but selling calls, naked calls, has the exact same risk as a naked short stock position. We've all seen what can happen to a naked short stock position this year with GameStop and AMC. So I'm not a big fan of taking any type of bearish strategies where you truly have unlimited risk. I'm far better selling a call credit spread, buying a put option, buying a put spread. I will never, ever sell a naked call option. I do sell puts a lot. And this is something we talk about a lot in our option income generating strategies of selling short puts. Whether you do a naked or cash secured, that's up to you. That's based on your own risk tolerance, but we do talk about selling puts quite a bit. Rolling to a new debit spread after a large move against me. So Alfred, this goes back to risk management. I'm not a big fan of rolling losers because if you have a loser on a trade, that means your initial analysis was wrong. Just accept the fact that you're wrong and move on to the right on the next trade. You can't be right on every single trade. And what people do is they won't accept the fact that they're wrong, and they'll throw more money after bad money, and they lose. And what you can do is you can really lose a lot of money doing that. And that's another risk management technique that I've learned over the years is a losing proposition in the long run, is when people cannot let go of the fact that they were wrong on a trade and they just want to try to get themselves back to break even. So they risk even more money on the back of the money that they've already lost. And many times that is the type of behavior that leads to very large losses in the long run. So that's my view on rolling losers. I'm not a big fan of it. Do you ever use a coin flip method? I'm guessing that's a bit of a joke, but I'm not sure what the coin flip method is. What are some indicators, examples you could when selling cash secured puts? Great question. I tend to find that, stocks that are near bottoms, let's look at Delta Airlines, for example. I was looking at this today. One of the things that you'll notice with Delta Airlines, when stocks are near its bottom, is that you start to have stocks that are moving lower in terms of price, but momentum is starting to shift higher here. This type of positive divergence, lower lows in price, higher lows in momentum, that usually is a potential signal for buying the stock or near a bottom, right? So those are some of the technical indicators that you can look at. You can also look at how far the stock is below a long-term moving average. You can look at the fact that Delta Airlines has been in a bearish trend for quite some time now. And, stocks like this usually don't stay in bearish trends for that much longer. So you have to look at the length of time, and you have to look at, are there any indications that it's near a bottom, and maybe they're starting to see some signs of that. Those are some of the things that you can look at. Okay, that covers the questions that I have time for here today. I really appreciate everyone taking the time out here this afternoon. I hope that this was helpful in giving you a framework to think about when you're placing your options trade on the back of a technical analysis signal. Are you optimizing your strategy based on it? Because remember, you don't make money from your charts. You make money from your trades. So make sure your trades match up with your charts. With that, thank you so much. We'll send out the recording to everyone as soon as we finish here today processing it, and you'll get both the recording and the slides in the YouTube link. With that, thank you so much and have a great trading day.